Hi everyone, it's Professor Reiko here again. Today we're talking about warranties and how to account for them. Warranties fall under the contingency portion of this chapter because we're estimating something that's based on future events that we're not certain of at this point in time. All right, so there's two basic types of warranties, and you're probably familiar with those. The first up here is the assurance type warranty. Okay, that's the warranty that is just a result of the sale of the product. Meaning, if you go buy a TV, that TV comes with a warranty from the manufacturer. So that's that type of warranty. And then down here we have a service type warranty, which most commonly you think of as an extended warranty, and that's sold in addition to the product. So we'll talk about the accounting for each. All right, so for the assurance type, in the period of the sale, that's important, we are going to expense any actual warranty work performed. All right, so as we do the work, we'll expense it. And then notice this "and" here, which means we're going to expense something else, an estimate of work to be performed in the future. So that's why it falls under the contingency, because it's future work that we're uncertain of. All right, and so that kind of helps us uphold the matching principle. All right, so let's look at this example here. We got a 2-year warranty with the sale of a product. They sold them $1 million worth of product, expected to do $150,000 total warranty work, and during 2017 they did 85 of that work. All right, with the remaining coming in 2018. All right, so let's just walk through our journal entries here for this type of warranty. All right, so these first journal entries will all be in 2017. All right, so first we have the sale. So that would be, cash or accounts receivable, and debit sales revenue, just to record the sale. All right, and that's for the $1 million. All right, so that's just the sale of the product. Now, I know there would be a cost of goods sold and inventory entry, but that information is not given, so we're just going to skip over that. All right, now we actually do 85,000 of warranty work. So it says up at the front there, we're up at the top, we're going to expense any actual warranty work. So we have warranty expense, 85,000. And this could be any number of credits. It could be cash if we gave them their money back. It could be inventory if we gave them a new product. It could be wages payable if we paid somebody to do some work on that product to fix it. I'm less concerned with that. Okay, so once again, this is the sale. This is the actual warranty work. And the only thing left is now to estimate. So if it says we're going to do 150, we need to expense the estimated amount. Okay, so that means we have 65,000 more. All right, the sum of these two equals the 150 of work we expect to do. All right, and we call this estimated warranty liability. All right, you could probably call it warranty liability as well. It'd be fine. It just depends on what your book calls it. All right, so once again, so notice now this all three of these is in the, or all of these journal entries are in the period of the sale. So the revenue and all the expenses are all covered. All right, so we have the actual work, and then we have the estimated future work right here. All right, in 2018, let's just assume we did all 65,000 of the work. All right, so we would reduce the warranty liability. Now, chances of us doing exactly 65,000 are slim, because that number is probably never going to be perfect because it's an estimate, but that's okay. And then we are going to, so this is them actually doing the work in 2018, but notice now we're not expensing it because we've already expensed it right here in this journal entry. All right, and then it'll be cash, inventory, or wages payable, or something like that, depending on what's happening. Okay. And then we would just start that process back over every time we sell a product. So you can see as we're constantly selling products, this number is never going to zero out. We're going to estimate it and true it up at the end of each period and try to keep a number for all the future work on the books. Okay, so that's the assurance type warranty. Let's scroll down here and now do the service type or extended warranty. All right, so once again, up here, the warranty is sold separately from the product. Okay, so we have the sale of the product, and then when you check out, so anytime you go to Best Buy or Walmart, or even now on Amazon, when you check out, they ask you if you want some sort of protection plan or something like that in case something happens to your product. Okay, basically this is just a good way for them to make some extra money. All right, so you probably should really kind of educate yourself on whether it's a good idea or not to purchase those. All right, so the companies defer the revenue. Okay, so I've seen it called deferred revenue, unearned warranty revenue, So probably either of those are fine. And look, it says we're going to defer it and recognize it on a straight line basis over the life of the warranty. Okay, so let's do that now. All right, so we've got a company. They sell a 4-year extended warranty with their product. During 2017, they sold 20,000 warranty contracts for $50 each, and they spent $85,000 servicing those warranties during the year. All right, so we have 20,000 warranties times $50 each. All right, so we have $1 million that we sold in warranty contracts, right? So the journal entry to record that is cash or accounts receivable, depending how it's paid for. And then we'll call this unearned. That's a N-E-D, warranty revenue. So remember, unearned revenues, we covered that in an earlier video, are liabilities. Okay, so unearned warranty revenue, like I said, I've seen it called deferred revenue for extended contracts or extended warranties. Any of that is fine. All right, and that's the million. All right, so notice in this one, we don't have a journal entry for the sale of the product because that's a separate transaction when we're dealing with these types of warranties. So this 1 million refers to the sale of the extended warranty. It's not the sale of the product. All right, during the year, we do 85,000 of work. Okay, and notice this journal entry, the cash, inventory, wages payable, whatever the case may be. So notice this journal entry for actual work is the exact same as up top there. Okay, so regardless of your what type of warranty you're dealing with, when you're actually doing the work in the period of the sale, you just expense it, and then you could have any number of credits depending on what's going on. All right, now at the end of the period, remember what it says. We're going to recognize the revenue from the sale of these warranties on a straight line basis. All right, so what that means is I'm going to abbreviate. We're going to take off the unearned warranty revenue, reduce that, and we're going to recognize warranty revenue. All right, so remember, we had 1 million in the sale of warranty contracts, and it's a 4 years that were the extended warranty last. All right, so that works out to be 250,000 per year. So we're going to reduce the liability. Remember, unearned warranty revenue is a liability. So we're going to reduce the liability, okay, and recognize revenue. So remember, this goes to net income, to my income statement. All right, and then if I had a T account for the unearned warranty revenue, all right, I would have the 1 million. I'm going to leave off the extra zeros. I have 250 that I just reduced it by. So that's 750,000 that's left in it. And remember, that reflects the next 3 years where I'm going to recognize that revenue evenly over those 3 years. All right, so if you compare these two journal entries right here, you can see I've got revenue of 250 versus expense of 85 on those contracts. So you can see, I know these numbers are just made up, but you can see why companies are always pushing these extended warranties, because most of the time people forget they purchased them, or they don't know how to go back and take things in, or they just don't feel like going and doing it. And so it is just easy money for the people. That's why they're going to push it when you check out at Best Buy and Home Depot and Walmart and wherever the case. And even now on Amazon, when you're checking out online, they ask you for the protection plan, this and that. And so, typically I would encourage you to not purchase these, because you can see the reason they push them so hard is because it is a money-making opportunity for them. Okay, and so over the next years in this, so this is all 2017. In 2018, we were going to make these exact same entries. We're going to expense what we actually did, and then we're going to compare it to the 250,000 revenue. So each period, each year, we'll be able to see whether the warranties worked at a profit or a loss for us during that year, and then we can look in total after the 4 years are up. All right, so these are our two different types of warranties. So once again, you can see how this easily could be a problem on a test. All right, so make sure you are very clear, extended warranty versus assurance type warranty, and understand the difference in those journal entries for each. All right, so we got one more video to do for this, and it's on asset retirement obligations. Now, like I said in an earlier video, if you're using the KESO book, it's actually in this chapter. If you're using the Spiceland book, it's back in your fixed asset chapter. So just depending on what chapter you're in, that's where you're going to find it. So that's why I broke it out into a separate video. All right, so I hope this helps you understand warranties a little bit better. All right, and be sure to tune in next time and share these with your friends, and hopefully it's helping you kind of supplement what your teacher is already teaching you. Thanks.